If you've got a 401k, listen up, because the rulebook for your retirement savings is on the verge of a massive shakeup. A new executive order signed in August 2025 by President Trump has started a process to allow you to invest your savings into higher risk, higher fee investments that have been off limits to the public for decades. And we're talking about the kind of investments that have made some people incredibly rich, but others, well, let's just say not so lucky. So this is one of the biggest potential changes to retirement investing that we've seen in years, probably decades, moving us beyond the familiar world of just simple stocks and bonds and mutual funds into territory previously reserved for only the ultra wealthy. So, is this a golden ticket to new wealth or a devastating mistake for your financial future? We're going to break down exactly what this seismic shift could mean, what these new assets are, their incredible potential upside, but also the devastating risks that could derail your retirement. For as long as most of us have been investing, 401ks have been, well, pretty straightforward. You invest in publicly traded stuff like stocks, bonds, and mutual funds. And these are things that you can buy and sell any single day with prices that you can visibly see and track every single day. The issue is all of that might be about to change. In August 2025, President Trump signed an executive order called Democratizing Access to Alternative Assets for 401k Investors. This order basically told big financial regulators like the Department of Labor, the SEC, the Treasury, to start rewriting the rules to make it easier for 401k plans to offer these so-called alternative assets. Now, this is a huge reversal of previous guidance that warned against these investments because of how complex they are and how liquidity constrained they are. The official goal is to democratize access to investment classes that, until now were pretty much exclusive to big institutions and people with a net worth over $1 million and sometimes over $5 million, depending on the actual investment. And the argument is that opening these up levels the playing field and gives everybody a shot at the higher returns these assets can potentially deliver. So, what are we actually talking about here? We're talking about private equity, private credit, hedge funds, venture capital, and maybe even digital assets like cryptocurrencies. This isn't just a minor tweak. This is the beginning of a fundamental rethinking of what actually belongs in a retirement account. So what are these alternative assets? And don't let the jargon fool you. It's often designed to be confusing. But think of the stock market, like a company like Apple or Amazon, as a public park. Anybody can go there, you can see what's going on, and you can buy a small piece of the action. The rules are clear, and everything is very transparent. Alternative assets are like a members-only VIP country club. So this is where you find private equity. Instead of buying a few shares of a publicly traded company, a private equity fund buys normally a controlling interest, at least 51%, of a private company, or takes a public company back to private. They then try to improve that company over the course of 3, 5, 7, 10 years, whatever it might be, and they then sell it for hopefully a huge profit. The potential returns can be massive, but it's all happening behind closed doors. Then there's private credit. Instead of buying a normal publicly traded bond, you're basically becoming the bank. You're lending money directly to lower middle market companies that either can't or don't want to go to the public market and issue bonds. And finally, you've got assets like private real estate funds that own huge commercial properties or maybe even digital assets, which includes Bitcoin, Ethereum, other types of crypto. The key things all these assets have in common are, first things first, they're not traded on a public market, except for crypto. Number two, they are illiquid, which is just a fancy word for they're hard to sell. And number three, they're opaque, meaning it's really hard to know what they're truly worth at any given point in time. And for years, regulators kept these out of 401ks for exactly those three reasons. However, now the process has begun to actually open the doors to allow every investor that opportunity. All right, so why on earth would anybody want this risky, complicated stuff in their retirement account? The answer, in a word, is returns. I mean, this is the get rich part of the equation. So the main argument is diversification and growth. The public stock market is dominated by just a handful of giant companies. You know, a lot of times you've probably heard about the Magnificent Seven, which are 7 of the largest companies controlling future returns and all those things. So that tends to be a bit of a problem that people have with just investing in the publicly traded stock market. However, if we start adding assets that don't move perfectly in sync with the stock market, you can theoretically lower your overall portfolio risk while hopefully increasing potential returns. But the real carrot that's actually being dangled is this illiquidity premium. So the idea goes like this. Because you're agreeing to tie up your money for a long time in something that's hard to sell, you should be rewarded with higher returns than you would normally get from, let's say, a publicly traded stock. And historically, the top private equity funds have delivered returns that absolutely crush the S&P 500. Now, proponents argue that everyday investors have been missing out for years and years and years. Why should only the wealthiest get access to these incredible growth engines? Opponents point to studies suggesting that adding even a small, let's say, 10% slice of private assets to your portfolio could significantly boost your retirement wealth over the course of a 40-year time horizon, assuming you get access to the good ones. That's the key. So this change could allow your target date fund to put a small portion, maybe 5 or 10%, into these private investments, which gives you a taste of those exclusive returns. Sounds great on paper, right? A chance to turbocharge your 401k with the same tools that the super wealthy, super rich, uber wealthy use. But this promise comes with a very dark side as well, and that's important for us to talk about. Now, before we dive into the ruin you side of this, if you're finding this breakdown valuable, do me a favor, hit that like button. It really helps the channel, and it helps us to get this information out to more people like you who want to hear it. Thank you. Let's flip the coin over and talk about the ruin you part of the deal. Yeah, this part is not as fun, but we have to do it. For every story of private equity success, there's another story of devastating losses, incredibly insane fees, and then money you actually can't touch. You can't gain access to it. And this is where the dream goes to die. First, and this is the big one, illiquidity. When you buy a stock, you can sell it tomorrow. With private equity, your money is often locked up for 7 to 10 years. Think about that. What if you lose your job and you need some cash? What if you want to take a 401k loan for a down payment on a house? Too bad. That slice of your money stuck. What if the market crashes and you want to rebalance? Can't do that either. You are just a passenger on a ride you can't get off of. Second, the fees can be astronomical. The classic model in private equity is called 2 and 20. They charge a 2% management fee on your money every single year, plus they take 20% of the profits. So your average S&P 500 index fund charges something like maybe 0.1%, right? On a $100,000 investment, that 2% fee is $2,000 a year, whether they make money or not. An index fee, a heck of a lot lower than that. We're talking about maybe $100. And that difference is going to cost you hundreds of thousands of dollars over the course of your investing career. Now, the version sold to 401ks might use a different fee structure, but you can bet they will still be miles higher than what you're used to. Third thing is the lack of transparency. How much is your private equity investment worth today? The real answer? Nobody knows for sure. These assets, they're not priced daily like stocks are. They're valued every so often, maybe once a quarter, more likely maybe once a year, using complicated internal math or third-party valuations using assumptions. So that means your statement could show a gain, but it's just an estimate. Hopefully it's in the ballpark. You're not going to know the real value until everything gets sold years down the road. So finally, you have to ask who really benefits here. The private equity industry has been desperate to get its hands on the $12 trillion that's in 401ks. That's an incredible opportunity for them. This change could unleash a flood of new money, which is your money, for them to manage and collect fees on and hopefully buy incredible businesses that grow and you end up benefiting in the long run. Now, what about your employer? They now have the insane task of trying to pick winning private equity funds, a game where the gap between, the best and the worst is substantial. It's gigantic. If they get it wrong, it's your retirement that's on the line. This isn't just some far-off debate anymore. The wheels are already in motion. These changes, they'll probably likely show up first in very large 401k plans, probably blended right into the target date funds many people already own. You might not even notice it at first. So, what should you do? Well, first, you want to play detective. You want to pull up your 401k's fund options. You want to read all the fact sheets, especially for your target date funds. You want to look for phrases like private equity, private credit, or alternative assets. Figure out what percentage of your money, if any, is going into these illiquid investments. Second, start asking questions. Ask your HR department if they plan to add these assets to the menu. Ask them how they're planning to handle the risks of higher fees and locked up illiquid money. Remember, the employers, they have a legal duty to act in your best interest. Make them prove they are doing it. Third, review your choices. If you're not comfortable with these risks, and honestly, many people probably won't be, you still have a choice. You can almost always opt for pure, low-cost index funds instead of a target date fund that might have these alternatives already baked in. And for the vast majority of people, a simple, cheap, and transparent portfolio of stock and bond, index funds, or mutual funds is really still the most reliable way to build wealth. It might be boring, but it works. This new world offers the potential for higher returns, but comes at a steep price. Higher fees, less liquidity, and a shocking lack of transparency. That's a gamble the wealthy can afford to take, and that's why there have always been asset requirements in the past, whether $1 million or $5 million, to actually participate in these. But this is a dangerous one to push on the average American saver. So proceed with caution. It could benefit you, but make sure you do your homework. This 401k shakeup is a true double-edged sword. So on one side, there's the exciting promise of getting access to investments that could boost your long-term returns and potentially add hundreds of thousands or maybe even millions of dollars to your net worth over time. On the other hand, you've got a minefield of higher risk, higher fee, complicated products that you may not understand that could lock up your money and drain your nest egg, all for Wall Street's benefit. The rules of the 401k are beginning to be rewritten. While, it might make a few people rich, the danger of it ruining the retirement dreams for many more is very, very real. And the key is to pay attention, ask the hard questions, do your own research and due diligence, and remember that when an investment sounds too good to be true, it almost always is. Your financial future depends on it. What do you think? Is adding private equity to your 401k a risk worth taking? Let me know your thoughts in the comments below. And if you want to stay on top of the financial changes that actually matter, make sure you subscribe and hit that bell so you don't miss what's next.